Hello, everybody. This is Michael Reese, Certified Financial Planner, and I am sitting here with Larry Flynn, who I like to call Accountant Extraordinaire. Larry, welcome to our discussion today.
Hi, folks.
Today, Larry and I are sitting here because we are starting this is class 1 here out of 3 classes. And the purpose of these classes is to simply help you better understand your tax return and better understand what your options are to significantly reduce taxation. The reality is that for many retirees, they have investment portfolios out there, nest eggs out there, and these investment portfolios are spinning off taxable consequences. And as a result, you end up paying way more in tax than you ever imagined that you would. And in fact, you're probably overpaying each and every year. And so we want to talk a little bit about today in these 3 classes, and starting here with class number 1, how you can avoid some of that. So when we look at a tax return, and we're going to look at one in just a minute, there are a few different line items that we really want to pay close attention to, because these are the lines that that our investment portfolio affects, right?
That's right.
So we have lines 8, 9, and 15 that we're going to look at in a minute. And ultimately, a lot of the entries on those lines lead to problems in line 20. And line 20 is, of course, your Social Security, right? And how much tax you pay in your Social Security. And then all of this affects 43 and 44, which is your taxable income and the tax you owe, right?
That's right.
So let's go ahead and jump in and look at a tax return. And I know this is going to be a riveting conversation for all of you. I know, Larry, you love this stuff, but I don't know how much the people listening do, or watching, I guess. Here we have a situation, we see this a lot. Somebody's got maybe $10,000, I've just rounded these numbers off, $10,000 of taxable interest, $10,000 of dividends, some municipal bond interest. They have some IRA distributions of pension, Social Security. That's their situation, right? Now, Larry, can you give us kind of a bird's eye view of what these items are up here on lines 8 and 9?
Well, Mike, line 8A, interest income, that's going to be interest they earn maybe from a CD at the bank, maybe some savings accounts that they have with the bank. It could be some bond funds that they hold, maybe even directly, that's paying interest semi-annually or quarterly.
So it could be a bond fund or maybe bonds directly,
Yeah.
either one.
Could be a bond fund held within their brokerage account that's spitting off interest.
And by the way, before we go too far, when you say brokerage account, I think you're referring to those accounts that are not IRAs or other retirement plan, right? It's just
Right.
money they hold in their personal name,
That's
right, outside of retirement plans or trust accounts, that
right.
kind
These
of
are
stuff.
investment accounts, right?
Okay. Okay.
Line 8B, 4,000. That's going to be municipal bond interest. A lot of people, municipal bonds are not taxable to the federal.
Okay. Well. Let's stop right there. So municipal bond interest is tax free. Why does it show up on a tax return? I mean, why does the IRS need to know that information if it's tax free?
Well, they want to know the number because it actually affects how much your Social Security is taxed. Somebody could be thinking they're wise by taking that $10,000, let's say, in interest income and $10,000 in dividend income and throwing it all at municipal bonds, right? Thinking, okay, I'm going to be wise and not pay any tax on that. And it could still affect how much that is taxed on the Social Security.
So the interest on municipal bonds, the interest isn't taxable, but the interest does affect how much tax you pay on your Social Security.
That's right.
Wow, I didn't know that. I bet you most people watching weren't aware of that one. And then let's continue. Line 9, what's that?
Line 9, that would be dividends. It could be somebody holds stock directly and it's paying them dividends, or it could be mutual funds which have stocks within them that are paying dividends.
Okay, so I get it. So when stocks pay dividend, so line 8 and 9 is like interest, dividends, anything that your portfolio is spending. What if you're reinvesting? Does that matter? I mean, what if you're saying, I don't spend that money, I'm just reinvesting it all?
Doesn't matter. As long as it's earning and paying dividends within the funds, you're going to pay tax.
You still pay tax?
Yes.
Holy cow. Okay. So if we kind of cruise down this return here, we're finding we're pulling money out of IRAs. Now, Larry, a lot of times people say, well, I'm 70 and a half. or older.
Mhm.
I'm forced to pull money out of my IRAs. I mean, I know, I mean, I think everybody knows that when it comes to these items up here, I mean, people can change investments around to be more tax efficient, right?
That's right.
And we're going to talk a little bit about that as time goes on. But here, if you're over 70 and a half, you're kind of forced to pull this money out. Is there really anything you could do to, is that in your control, or is that just a uncontrollable piece of the puzzle?
Well, it's not if it still remains in an IRA, but they could be potentially put it into a Roth IRA.
Oh, so they could convert their IRA to a Roth, and there are no required distributions in Roth.
That's right.
Okay, got it. So really, if you look at a tax return, a person has the ability to control pretty much everything from line 8 down to line 15,
That's right.
right? And then pensions and Social Security you obviously don't control, but everything else we do. Now this is important though, right? Because all of this stuff up here affects how much tax we pay on our Social Security. In this example, if they're getting $24,000, they're paying tax on 20, right?
Mhm.
And if we scroll down, we see, okay, we have adjusted gross of 76. They've got, in this case, standard deduction to keep it simple, a couple of exemptions. And this married couple, they owe tax on $55,000 of income. And look at that, they have tax, $7,400 of tax, add some alternative minimum, that's always fun. And we're at $8,000 roughly, $8,100.
That's right.
So that's a lot of tax, I mean, I think. Well, let's kind of go back here to our little discussion today, because let's see what's going on here, because I noticed that it looks to me that this couple here, they're probably paying tax on pretty much their entire, there's probably not a lot of tax planning going on here. Would you say?
That I would guess that's true. Yep.
Probably the case. So let's take a look at, I want to take a look at this slide here, because Larry, I know this is something you and I talk a lot about. You know, I also know, I mean, you do over 1,000 tax returns a year. You do tons of them. And I know you've told me in the past, you tell me that I'm the only financial advisor that you ever come across that actually talks to you about this stuff. But this is one of these models that I know we talk about, and let's share with folks. And that is that when it comes to a portfolio and the taxes on that portfolio, we can take that portfolio and really separate it into three different buckets, right?
That's right.
So this first bucket is money that you need today. So that bucket represents, you know, look, if you need income today, that's all that should be in that bucket. And Larry, as you like to say, if you need money today, when should you pay tax on that?
You pay tax on it today.
Yeah, so you need it today, you pay tax on it today, right?
Sure.
Well, what about money you need tomorrow? Now, what if somebody, they say, okay, I need this part of my portfolio today, but you know, I won't need this money until next year. And then I won't need that money until 2 years from now, and then 3 years from now. When should they be paying tax on money they need tomorrow?
Tomorrow.
Wow, this sounds like it's rocket science. So tax, money they need today, they pay tax today. Money they need tomorrow, they pay tax tomorrow.
That's right.
What about money they may never need? I mean, a lot of people, they have money that they've set aside for their kids, or maybe it's money that, maybe it's nest egg money, where they're saying, look, this is money that, you know, we don't know that we're really going to need it. It's our safety net. If we need it, we need it. We might need it for health care, for new car, but you know, right now we don't really need it, but we might need it later, but they're not sure.
Right.
So they may never need that money. So when should they pay tax on that?
Well, let's say never.
Okay. So in other words, I don't know, this sounds like a very complicated structure you have here, Larry. You're saying that so if they need it today, they pay tax today. If they need it tomorrow, that's when they should pay tax. Not today, they should pay it tomorrow.
That's right.
And if they may never need it, then they should maybe never pay tax.
That's right.
Is that fair?
That's right. That's very fair.
Okay, so let's go back. So the problem that we have on this tax return is what? All this tax that they might need if they need it today, tomorrow, or maybe never, it doesn't matter. They're all paying it right now.
That's right.
And is that pretty common? Do you see that happening quite a bit out there?
I do.
I mean, isn't that so? Here are these people are retired, and they're paying tax on money they may never need, but they're paying it every single year.
That's right.
That's and why do you think that is?
Well, because they're sitting in their investment accounts and nobody's talking to them about any alternatives.
So you're saying the investment advisors they're maybe focusing on the investments, but they're not paying much attention to what's happening from a tax perspective.
That's right.
Okay. So let's take a look. You ran one of these, the same tax return. And just again, for today's discussion, it's the basics. We said, let's be very simple, right? And we said, all right, I think you said, what if all of this money happened to be nest egg money that they may never need? They didn't need it now and they didn't necessarily need it next year.
That's
right? So what would the tax return look like if it were properly, if their investments were properly positioned, right? And so that's what we have right here. And here, so what's happened? We've basically said, look, if it's properly positioned, we may never need it, therefore it shouldn't show up on the tax return, right?
There you go.
And now look at this. Now it's just their pension and Social Security. Now before, they were paying tax on $20,000 of the Social Security. Now it's only
2,000.
$2,000. Their taxable income before was $76,000. Now it's only $26,000. And after, if you look at this, after their deduction and their exemptions, their taxable income, which was $55,000, is now only $5,000. Their taxes were $8,100. Now it's $500.
Huge difference.
Huge. So that's a difference of $7,600 a year. Now, you know I'm no genius, but gee, if someone saves $7,600 a year, and by the way, this is not uncommon. We see this all the time, don't we?
Mm-hmm.
But if they could save tax on $7,600 a year, over 10 years, how much in tax could they save?
$76,000.
And that's probably a pretty significant sum, right? So there you go. That's really the gist of today's discussion. This is class number 1, just really helping you understand. Look, a lot of times people are overpaying on their taxes because they're not planning with their investment accounts. And if you plan properly, you can often save thousands of dollars a year. And as we go into the next couple classes, I think we're going to talk about this in a little more detail. So that's it for class number 1, and look forward to seeing you in class number 2.